Hey folks, been getting a lot of questions on the sort of digestion, or maybe we'd call it indigestion in the market here that we've had for the past 2.5 months. Wanted to give you a quick update. Let's get to the charts. So a lot of people are essentially staring at your sort of broad indices like the S&P 500. I'll quickly bring it up here as well, which continue to essentially make all-time highs more or less, every week. Of course, at some point that'll end or stop, and I do think we are probably getting quite close, in fact, very close to that sort of pattern pausing for a while. Maybe the S&P pulls back towards 50-day moving average, maybe goes back towards the 100-day around 4,100. These are all, very small pullbacks within the context of, the big rally we've had year to date. Just to give you some context, 50 days about 3.5% below the current market, 100-day maybe 5-6%. So there's a pretty good chance of that happening, which really doesn't change anything in a long-term picture. And when I say long-term, we're really looking at intermediate term throughout year-end, which we do think will have higher prices, particularly in the reopening trade. Having said that, what has kept the index afloat is essentially the rolling correction or rotation, if you will, underneath the surface, where we've seen the reopening and even the reflation trade morph into sort of algorithms putting money into your classical mega cap tech names like Apple, Microsoft, the big names that have a very heavy market concentration, market weight in the indices, which is why the S&P's pulled higher. It's not that the S&P's every single stock's going up. In fact, breadth has been quite bad. And the way you can see this, if you look at the equally weighted, and I wouldn't suggest everyone look at this ETF. This is the RSP. I'm going to see if I can type it in here. So in case you can't see it in the upper left-hand corner, the ticker symbol for this ETF is RSP. So this is the equally weighted S&P 500, meaning that every stock has equal weight. So Apple isn't 7% of the index or whatever it is in the normal S&P, but it's just as much as every other stock, which tells you that when the market is going sideways, which the chart will show you much more accurately if the average stock in the S&P is going up or down or sideways, and you can see truly we are going sideways. I would expect more of this to happen, and one of the things that you can do in order to not get chopped up throughout the summer months, and we do think this can continue for some time, is to respect the ranges. We would expect, to be a seller at the upper end of the range, maybe a buyer at the lower end of the range. And you can extrapolate that to other parts of the market or even individual stocks, although it's a little bit easier to do on like sectors and groups. So if you look at something like, let's look at industrial stocks, for example. Well, industrial stocks in the very best case have a range from about 107 currently to about 99. Right now we're right in the middle, so it's not a really easy call to make, but certainly if you reach the upper end of that, you'd be a seller, whereas you'd be a buyer towards 100. If you look at, for example, material stocks, right now they are certainly closer towards the lower end than they were from the higher end. So the lower end in our view is probably closer to 80. So all things being equal, probably at the margin a better buyer rather than a seller, but again, not exactly a buyer because the lower end of the range really is 80. Let's look at, for example, the XLK, which represents tech stocks. Not much of a well-defined range here because these continue to push higher as yields have gone lower, but our model suggests that we are very much at the upper range of this, with a range that's quite wide on this one, about 155 to about 145. So if you were to get to 145, to give you an example, that's about 5-6% lower. You'd want to be a buyer rather than a seller. So again, we are in a market digestion, or again, maybe it's an indigestion period. We continue to see this rolling corrective move, and it's frustrating a lot of people that are very short-term focused. Swing trading type of stuff is somewhat challenging to do, not impossible, but you want to adopt your strategy from trying to play breakouts, if that's your thing, to respecting the ranges. And that's really what I want to come across. The point I want to bring across is to kind of make sure that there's still plenty of stuff to do even on the swing trading stuff, never mind the investment stuff. You just have to adapt a little bit to respect the market environment. And that's something that we talk to our members on the research side about several times a week. It's just important not to just look at a chart and call that an analysis, but to respect the bigger environment, take into consideration things from positioning to the structural situation in the market to interest rates and inflation, and that gives you a much better picture and feel than just looking at a chart. But looking at a chart, you can still make money on the swing trading side. In this case, we think range bound, so play the range. Hope this makes sense. Any questions, comments, let us know. Thumbs up, and we'll see you soon.